Fundamentals of Accounting Module 1, Lesson 2. Lesson 2, the Accounting System and Financial Statements. 1. Understanding raw financial transactions and useful financial information. Accounting is a structured process that transforms raw financial transactions into useful financial information, allowing businesses to track financial health, comply with regulations, and make informed decisions. What are raw financial transactions? Raw financial transactions are individual business activities that involve money but have not yet been processed, categorized, or analyzed. These transactions occur daily and can include sales and revenue generation. A store sells a product for $50. Purchases and expenses. A company buys office supplies for $200. Payments and collections. A customer pays an invoice. Loans and financing. A business takes out a loan to expand operations. Salary and wage payments. Employees receive their monthly salaries. Real-world example of raw financial transactions. Imagine a bakery. Throughout the day, it makes dozens of transactions. A customer buys a cake for $20, sale. The bakery purchases flour and sugar for $500, expense. It pays employees $2,000 in salaries, expense. It receives an electricity bill for $300 but hasn't paid it yet, accrued expense. At this stage, these are raw transactions. They exist but have not yet been processed into useful financial information. What are useful financial information? Once raw financial transactions are recorded, classified, and analyzed, they become part of a useful financial information. These statements summarize business activities and provide a clear financial picture of the company. The 4 core financial statements. 1. Balance sheet shows a company's financial position, assets, liabilities, and equity. 2. Income statement summarizes revenues and expenses to determine profit or loss. 3. Cash flow statement tracks cash inflows and outflows to assess liquidity. 4. Statement of changes in equity shows how owners' investment and retained earnings change over time. Real-world example of useful financial information. Let's go back to the bakery. After recording and categorizing all transactions for the month, the bakery's accountant prepares financial statements. Balance sheet shows the bakery has $10,000 in assets, including cash, inventory and equipment, and $3,000 in liabilities, unpaid bills, and loans. Income statement shows total sales of $15,000, expenses of $10,000, and a net profit of $5,000. Cash flow statement reveals that even though the bakery made $5,000 in profit, only $3,000 is in cash, with the rest owed by customers. Statement of changes in equity shows that the bakery's retained earnings increased because the owner reinvested the $5,000 profit into the business instead of withdrawing it. These financial statements turn raw transactions into useful financial information, helping the bakery owner make strategic decisions, such as expanding the business, controlling costs, or improving cash flow management. Why this transformation matters. Raw financial transactions, individual sales, expenses, payments, on their own, don't provide a clear financial picture. Useful financial information help businesses see if they are profitable, income statement, track how much cash they have, cash flow statement, monitor their financial stability, balance sheet, understand owner investments, statement of changes in equity. By converting raw financial transactions into useful financial information, businesses gain the ability to plan, grow, and avoid financial problems. 2. The accounting process. Accounting is a systematic process that converts raw financial transactions into structured business, allowing businesses to make informed decisions. This process consists of 5 key steps. Step 1. Identifying transactions. A transaction is any financial activity that affects a company's financial position. Transactions must be measurable in monetary terms. Only events involving money are recorded. Affecting the company's financial statements. Transactions impact assets, liabilities, equity, revenue, or expenses. Examples of business transactions. A business sells products and receives $1,000 in cash, affects revenue and cash. A company takes out a $5,000 loan, affects liabilities and cash. An office pays monthly rent of $2,000, affects expenses in cash. The role of accrual accounting, recognizing expenses before payment. Accounting follows the accrual basis, meaning expenses and revenues are recognized when incurred, not when cash is exchanged. Example of accrual accounting. A marketing agency provides services in December but won't receive payment until January. Under accrual accounting, the revenue is recorded in December when it was earned, not in January when cash is received. This method gives businesses a more accurate financial picture compared to the cash basis, which only records transactions when money is received or paid. Step 2. Recording transactions. Once transactions are identified, they must be recorded systematically. This is done using journals and ledgers. Journals, the first step in recording transactions. A journal is a chronological record of transactions, written in debit and credit format. Each entry includes date when the transaction occurred, accounts affected, assets, liabilities, revenue, expenses, or equity. Debit and credit amounts, based on double entry accounting. Every transaction affects at least 2 accounts. Example of a journal entry. A business purchases office supplies on credit for $500. The journal entry is debit, office supplies asset, $500. Credit, accounts payable, liability, $500. Journal entry explanation. To record the purchase of supplies on credit ledgers. Organizing financial data. A ledger is a collection of accounts summarizing all transactions for each account. Cash, sales, expenses, etc. Ledger balances are later used to prepare financial statements. Step 3. Classifying and summarizing transactions. After transactions are recorded, they need to be categorized into the correct financial accounts. Categorizing financial transactions. Assets, cash, inventory, property, equipment. Liabilities, loans, accounts payable, unpaid bills. Revenue, sales, service income. Expenses, rent, salaries, utilities. Equity, owner's capital, retained earnings. Trial balance, ensuring accuracy. A trial balance is prepared to check that total debits equal total credits. If they don't match, there is an accounting error. Adjusting entries, correcting mistakes. At the end of an accounting period, businesses make adjusting entries to correct errors and include unpaid expenses or uncollected revenue. Example of an adjusting entry. Accrued expense. A company receives a $2,000 electricity bill in December, but will pay it in January. The adjusting entry in December is debit, utilities expense $2,000. Credit, utilities payable $2,000. Adjusting entry explanation. To adjust accrued utilities expense incurred for the period. This ensures the expense is recorded in December, even though payment happens later. Step 4. Preparing financial statements. Once transactions are classified and summarized, financial statements are prepared. These statements help businesses assess performance, make decisions, and comply with tax regulations. What comprises a financial statement? Income statement shows profits or losses over a period. Balance sheet displays assets, liabilities, and equity at a point in time. Cash flow statement tracks cash movements. Statement of changes in equity explains changes in owner's investment. Each of these statements provides different insights into a company's financial health and performance. Step 5. Analyzing financial data. Once financial statements are prepared, businesses analyze the data to make informed decisions. Profitability analysis. Are revenues covering expenses? Liquidity analysis. Does the company have enough cash to pay debts? Growth analysis. Can the company expand based on financial trends? Example of financial analysis. A restaurant sees that 40% of its expenses come from food waste. By analyzing financial statements, it decides to improve inventory management, reducing waste, and increasing profits. 3. Overview of the 4 core financial statements. Balance sheet. Financial position. A balance sheet shows what a company owns, assets, and what it owes, liabilities, at a specific date. Formula. 1. Assets equals liabilities plus equity is the basic equation that shows how assets are financed by liabilities and equity. 2. Assets, liabilities equals equity is a rearranged version of the same equation, focusing on how equity is calculated. Example. A tech company has $100,000 in assets, cash, inventory, equipment, and $40,000 in liabilities, loans, accounts payable. The remaining $60,000 is owner's equity. Income statement, profitability. An income statement, profit and loss statement, reports revenue and expenses over a period, showing net profit or loss. Formula: sales less cost of sales equals gross profit, less operating expenses equals net income. Example: a bakery sells $20,000 worth of cakes, but spends $12,000 on ingredients and labor. The income statement shows a net profit of $8,000. Cash flow statement, liquidity. A cash flow statement tracks where cash comes from and where it's spent. It includes operating activities, sales, payments to suppliers; investing activities, buying equipment, selling assets; financing activities, loans, owner withdrawals. Example: a consulting firm has a net profit of $10,000, but only $3,000 in available cash because clients haven't paid yet. This shows the importance of monitoring cash flow. Statement of changes in equity, owner's investment, and retained earnings. This statement explains how equity has changed due to net profit loss, owner's withdrawals, new investments. Example: a small business starts with $50,000 in owner's capital. After earning $20,000 in profit but withdrawing $5,000, the equity increases to $65,000. Why this process matters. An effective accounting system ensures businesses move from scattered financial transactions to well-structured insights. First, businesses identify and record transactions accurately to track financial activities. Next, transactions are classified and summarized into organized reports, making financial data meaningful. Finally, financial statements provide a clear picture of financial health, guiding businesses in decision-making. By following this process, businesses ensure accuracy, compliance, and profitability, allowing them to make informed financial decisions and drive sustainable growth. End of Module 1, Lesson 2.